Right after finishing this last expiration cycle on the high note with an all-time high, no less, after multiple years, we started this new expiration cycle on the high note. Now we're also starting to get into earnings season with a very, very good 3-month return, and we'll see. Last time we had this kind of return, it didn't work out so well over the course of the next quarter. We'll see if that ends up changing again. Again, starting a new expiration cycle, heading into the end of January, which is a very important month that kind of gives us an idea of the rest of the year, election year. A lot of seasonal factors working in the market's favor, though we already have a couple here early in the year that aren't, and we'll see if we get the trifecta by the end of this week. We should have a pretty good idea of whether we're going to finish the month up or down. So we're going to break down kind of what's driving a lot of this price action, especially the last few days. What's driving a lot of this bullishness that's really kind of taken off. How widespread is it? It's been, for the bulk of this January so far, it's been concentrated. Speaking of concentration, we also kind of take a look at just how concentrated the markets are relative to other periods where we've been concentrated in the past. What's the breadth look like? What's the money flow look like? How bullish are we really here? So we break all that down, and we'll take a look at the rotations into different sectors. And then, of course, our trade idea of the day, a stock that's breaking out on its own. We'll talk about how to trade that and look at its charts. Let's go ahead and get started. Today is Monday, January the 22nd, 2024. This is the Market Outlook from MarketScholars.com. My name is David Settle. Hey, before we get going too far, I invite you to subscribe to our YouTube channel with this icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com. Follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group that we've created. All right, if you're watching us on our blog here, check out some of these other things over here on the right, including our Market Outlook live video. Come down to the bottom, click this heart. It opens up this tab. Hit that like button there. Same thing here, click on this thumbs up icon. It opens up this tab, hit that like button there as well. Again, the more you do those things, it helps us really get our content out to all of our followers on those platforms. It's a big deal for us. That's why we always ask. So thank you to those who like these day in and day out. Those who don't, you can do right now with 1 or 2 really easy clicks. All right, let's take a look at the S&P 500 with the market forecast indicator here. You can see that the intermediate line and the market sentiment line are pretty much sitting right on top of each other, right near that 90th percentile. So still at very strong bullish levels. The near-term line back over the last 2 days, going into the weekend, into options expiration, then coming out of it, with the momentum line failing to get into the overbought territory, before dropping back down into, below the chart's midpoint. We are kind of hugging that 2.5% line above the 30-day moving average. So a nice little kind of near-term bounce off of that bearish low point there. All right, well, off of a low point that was in bearish territory. I wouldn't necessarily say it's a bearish low point since it was a higher low and it wasn't necessarily too oversold. It was at the lows, so that nice little bounce off of those lows that day kept us from getting down to an extreme low on the momentum line, and then the near-term line on that day at the lows was below the 20th percentile. So we avoided having another day like this one coming out of the beginning of the year, and because of that, we have a positive month-to-date return, which is good because we're kind of trying to avoid the trifecta of bearishness, right? The Santa Claus rally, the first 5 days of the trading year, and then the full month of January. So as of right now, we're doing okay. We closed the 47.69 is the magic number, and we're almost 100 points above that. We actually did get 100 points above it at the high of the day today. So far, so good in that regard. Of course, the NASDAQ 100 has been a primary driver of this. It's sitting at new highs as well. The intermediate lines above market sentiment. The near-term lines up there too. The momentum line's down because the range today is a lot smaller than normal. But still very strong move. You notice it never did dip. The near-term line never did dip in the bearish territory here. So we've actually been on the near-term rally this entire time, coming off of that bull tag. That the SPX never did get that bull tag pattern. The Russell 2000 actually got a bull tag pattern, continued lower for a couple days before this latest run, has really skyrocketed up. Look at that momentum line hitting extremes on Friday, and then the near-term line following suit today. Avoiding the intermediate line, avoiding getting into bearish territory, bouncing up slightly here, and then getting back above the moving average, and you almost have dark green shading a green line again there. So a little bit of a pullback down to that 38% Fibonacci retracement. Not enough to get like dark pink shading and a red line, though we did get dark pink shading for a couple of days, but now we're right back, bouncing back up again. So nice, good start to the exploration cycle for the Russell. And of course, after getting a cluster on Friday on the Dow Jones Industrial Average, we avoided a cluster today with the market sentiment line, no less, and really with the market sentiment line above the 90th percentile, no less. Then we finished down on the S&P 500. Actually, the Dow Jones is getting a cluster on this weekly chart so far this week. The S&P 500 got a cluster on the weekly chart last week. So first cluster that we've had in a while on there. The NASDAQ 100, you can see, also got a cluster last week with the big move to the upside, of course. Not the case in the Russell 2000, because the Russell 2000 last week was actually kind of down a little bit there. The intermediate line was almost crossing below 80, and now has crossed below 80, but still is above its market sentiment, and your near-term line is trying to make its way back to where it gets back above it. And now the intermediate's below 80, a cross back above it would be bullish. So that would be a good sign for the markets, for the Russell, kind of starting off this week. So far this week, remember, this is only one day, so that weekly chart's not over. Let's take a look at this other weekly chart here, and you can see, again, strong bullish candle. Again, not the strongest that we've seen, but again, we haven't had consolidation yet. We only briefly got below zero there, but barely with that red candle. But we have a higher close so far this week, closing above last week's high point. So we got some transitions that turn into convergence, kind of similar to what we saw over here when you got some bullishness, transitions, and more bullishness in 2023. And that's kind of what we're getting right now. Bullishness, transition, convergence essentially, and then now, as of right now, more bullishness. The PPO flirting with the highest level of this cycle, up to 5.58. That would be higher than what we saw during the previous peak. So, starting to make a run back up to very strong bullish levels. Of course, again, fueled by the NASDAQ 100, which is almost 10% on that, and a pretty strong candle itself. And then, of course, your Russell 2000, which is finally getting kind of a small bullish candle after last week's pretty strong bearish candle. Then you can see what's going on there with this PPO. Never did get that red arrow on that 10-week moving average on the Russell 2000 last week. We did have 3 red arrows on the Russell. It has now turned back into 2 greens, and probably one day away from having 3. Same thing on the Dow. You're probably a day away from having 3 green arrows there. You have 3 green arrows for 2 days now on the S&P, last Friday and today. And of course, your NASDAQ's been 3 greens for a few days now. So we're starting to get back into, and again, convergence. I mean, you got these no shading here. These are convergence periods. We don't have any pink shading except for on the Russell briefly, and even more briefly on the Qs. Enough to get the stochastics down below the 25th percentile on the Qs. You did not get that on the S&P, and you definitely didn't get that on the Dow. And you got well below 25 on the Russell. So you did have long enough, but pretty shallow. And it's really, really shallow in the Qs. You wouldn't even really call that an intermediate pullback at all. In fact, if you look at its intermediate line for the Qs, it got a bull tag, but it didn't get, the intermediate line got out of bullish territory, but didn't even get close to getting into bearish territory. So when you take a look at the 2-line versions of these charts, again, you can see the convergence here, and we are back, MACD's back above 0, but again, you don't expect, we had a brief little run there, and something similar here. I wouldn't expect a big long run. The MACD's been above 0 for quite a while, so it's not like we're starting a new intermediate rally here. And remember, there's a pretty sizable gap already between the 30 and the 200-day moving averages. So we're not starting a new intermediate rally. We're still and we still have we don't know if this is the late stages, but at least we do know this is a mature intermediate rally, right? The typical length of time is 1 to 3 months from low to low. So again, we're coming off of a low point over here in the end of October, so we're about 3 months into this one as of right now. So we don't know if this is the end. Hindsight will tell us that, but we do know that we're at the long end of a typical range for an intermediate rally to occur here. Looking at some of the other oscillators, if I look at the DMI, you can see we're back above 30. In fact, we're back above 35 on the positive indicator, back above the ADX. The negative indicator back below 20, so we're turning back up on the ADX there, again, without actually losing the trend that we had. IWM did lose the trend. We did drop below 25, but it did also turn back above 30 on the positive. Not quite yet below 20 on the negative there. Looking at the RSI and the CCI, they also jumped back up to bullish levels, almost back above 70, almost above 200 on the CCI. So extremely bullish, strong bullish levels there for the S&P 500. The Russell 2000, of course, back at least above the chart midpoints, not necessarily to bullish levels yet, but at least not to bearish levels, back above their chart midpoints. Looking at the Ichimoku cloud, the S&P maintaining its strong trend, IWM losing the weak bearish trend that it had. It had a weak bearish trend going. We're back above the blue line. We still maintain a positive rate of change. So again, you can see the type of rally it's going to take over the next week and a half to keep it positive. Of course, your SPY, the rate of change is very strongly positive and can be, even if we just went flat for the next month, it would still be a positive rate of change. But it's still a very mature bullish trend going on here, and you can see how wide the momentum from the cloud that we have. Looking at the Bollinger Bands, you can see we closed back outside the upper band for the second straight day, and closed outside the Keltner channel for the second straight day. So 2 days in a row now. Again, we're not starting a new bullish move because we've had bullish momentum, so we never did have any bearish momentum. So it's not like we're starting a breakout pattern here, and makes you wonder a little bit about, can we get a long period of run like this where we also kind of had a pause, a consolidation, we got out, and then we broke out again and maintained some bullishness for a while. The dots are red. They've been red. But we'll see they're probably a day away from turning green with this positive move. Pretty strong positive move, breaking out with the bandwidth that was at such low levels starting to turn up higher again. That's on the daily version of this. Of course, the weekly version has a pretty strong bandwidth, and we're still in the upper quartile of that rising bandwidth there. And you can see too, when you look at the weekly Keltner channels, that we are continuing to close 1, 2, 3, 4, 5, 6 out of the last 7 weeks we've closed above the upper Keltner channel with some very strong momentum as the bands are way outside the Keltner channel. Some very strong momentum here to the upside. So you see the strength of this move and the new 4-week high point that we continue to produce. We did yesterday. We got a new all-time high yesterday, very famously. Got a new all-time high again. So finally, after 2 years, getting back up there. And then today's move, you can see a very small range, filling in most of this morning's gap. But at least we got a new high, so it brought the Arun indicator back to 100, resets the clock, 6-day clock to get it below 70 before we really have to worry about a bearish breakout. And you can see the one touch here. Those tend to be pretty bearish when you get these one touches. They tend to be pretty bullish on the red line one touches, obviously bearish on the green line one touches. So to get a one touch and you're already starting to move lower, it's been a bullish sign for the markets, despite how even with the breakout here the last couple of days and bringing the size of the channel higher, it's still really low relative to where it's been in the past. Obviously today's, coming out of expiration, very small range today, filling again most of the gap, but 2.44 points, well below a really small ATR, below the average at 75 million shares trading hands. So 2.44 points is way down here, well off the chart for the 52-week range of the ATR. The volume at 75 million, also well below the average here and starting to move lower. Again, you already have a very low ATR as it is at 0.87, so well below 1% on the daily. And of course, you're approaching 2% on the weekly, which again, we got down to below 2% right before the COVID. We got down below 2% there in 2011 or 2021 right before. So you kind of get an idea, like, it's been a while, right? Since COVID, it's been a while. We've been below 2% for an extended period of time before. Right before 2018, we dipped below 2%. And then in most of 2017, we were below 2%. Let me get rid of this line. Below 2017, we were below 2%. That was, again, an extraordinary period of very low volatility. But aside from that, 2% is kind of like the low watermark in terms of how low, how extreme we get to the downside. And you can see that, of course, with the VIX. The VIX continuing its decline after peaking above 15 here briefly and above 90%. We're dropped back down to 13, though we're still just a little bit below 90. We're not really dropping down to extreme lows here on a relative basis. And the VVIX has dropped back below 80% again. So just like that, after dropping to extreme lows right before this jump that we had, we're right back to extreme lows again. And every time it drops below 80, it's really kind of sparked a jump in the VVIX, which typically correlates to a jump in the VIX as well. So something to kind of watch for, as the VIX itself is well below its average values, but still not breaking below the 200-day average values, but not breaking below some of these shorter term average. So it kind of gives you an idea of, things have kind of changed here a little bit as the VVIX itself really dropping back down again to extreme lows here below that 80% mark. But the VIX, it's kind of interesting to see it, jump up to the 200-day fail, come back down, but still kind of hold above some of these other average time frames. Kind of goes to show that we're not. There's pretty limited downside to the VIX because of how low it already is, and obviously the bigger risk is to the upside, considering especially that's probably the lowest 200-day average that we've seen. You have to go all the way back to right before COVID for the 200-day average value of the VIX to be below 15. It was kind of flirting with 15 here throughout most of this period. And then before that, again, I told you that 2017 timeframe was this an extraordinary period of low volatility. The 200-day average fell all the way down to 10, just below 10. But aside from that, you can see it doesn't get below 15. 2013 and 14, it dropped below 15 because of the QE3 that we experienced. But before that, pretty high values going all the way back to 2005 through, pretty much that rate hike cycle there where we had low volatility before the regime change at the beginning of 07 started the increase in volatility that sparked ultimately the recession, bear market that started in 2008 that we experienced in 2008. So kind of, really considering how low that the blue dotted line is, it's really important to kind of watch to see how we behave now. If we have a long period of below 15 throughout the rest of this year into 2025, or with that 200 days so low, it makes it really easy for a regime change in volatility to occur over the next 12 months. So it's something close. That's what I expect will happen, and we'll watch to see how that behaves here at the beginning in this first quarter of the year. Right now, let's take a look at what's driving this price action. You can see over the past 3 months, you've had this pretty significant drop in the dollar, pretty significant drop in commodities, and a pretty significant drop in yields, with TLT being higher. That's led to a 20% gain in the Qs and IWM essentially over the past 3 months, including this little bout of weakness that we've had. If you just look at today alone, so we'll come over here to today, right there, and just look at what's driving the price action here today. Again, IWM up 2% today, kind of a catch-up trade as it's been lagging behind the Qs, which were flat. The dollar was flat. Yields were down. Commodities were up a little bit. If I were to go back out again to kind of see from really the last 3 days when the S&P really took off of that low point on the 17th, so starting on the 18th there. So we'll zoom out to that last 3-day return. Again, you can see weakness in the dollar, relative weakness in commodities, and then lower yields. Lower yields being really the big driver of what's going on here. If you take a look at the 10-year yield especially, after being up for a little bit of time, now is down over the past 3 days, going from 4.106 down to now back below 4.1%. We'll see how temporary that is. So far as the failure of that 50-day moving average, we're not back below those other moving averages, the 8 and 17 there yet. So we'll see how temporary or not that move is. Of course, the dollar has been another big driver. It so far has failed at the 200-day moving average and the 50 for that matter, kind of sitting in between the two, but also still above the 8 and 17, which are also both above the 30. So we haven't quite broken back down yet on the dollar. And of course, crude oil is another factor, and crude oil is breaking above its 50-day moving average here as it's making its way up towards its 200-day. Of course, that's a big component here of the commodity index, which has been really bearish over the last couple of months. Big gap between the 30 and 200-day moving averages there, and now seems to be a basing, right? Big convergence pattern going on here on the MACD, and you're still kind of below the 17-day, haven't broken above that. So you can kind of see, what's been driving the risk appetite, and it doesn't look like we're starting like new legs lower in the case of commodities or in the case of the dollar, or it hasn't broken back down yet, or in the case of the 10-year yield, which also hasn't broken back down. Of course, the other big driver here of a lot of this risk appetite over the end of this past year was the odds for rate cuts, which really ramped up to like over 90% odds for March, and now we're down to 45% odds that we'll get a rate cut in March. So again, you can see we were at one point in time there over 90% that we'd have a rate cut already in March, and you can see it's ramping back up pretty quickly. If you take a look at June, which is kind of the next major cycle, the odds of rate cut are 100% for June and have been for a while. The odds of two rate cuts is 85%. So we're looking at between these four meetings, but really these three, we're looking at 2 cuts, and of course about a 33% chance of 3 cuts, which would be March, May, and June. So the odds. So it doesn't seem like we're going to get a very high probability of getting a cut in every single meeting. Of course, again, by the end of the year, the market had priced in 6. You can see it is still pricing in quite a few. We're currently at 5.25, so that's at 0%, and then the 5.25 is also at 0% because it's not even showing up here. So you got 100% odds of 2 rate cuts, and then now the odds of a third one, you're at 99.9, which is what the Fed has priced in their projections, and then you're at 97% for 4 rate cuts, and then you're at 83% for 5, and then now you're roughly 50-50 for the 6. So you're still you're still at a pretty decent probability that would have 6 cuts throughout the course of this year. And of course, again, when you get that many cuts, ultimately it brings the entire yield curve lower. Everything starts to drop, right? When the red line drops, which essentially is the effective Fed funds rate, the 3-month Treasury yield, when it starts to drop, everything starts to drop, as you can see. And again, we kind of had that during the going into the mid-cycle adjustment in 2019. And then through COVID, eventually made its way all the way to 0. And you can see that over here in 2007 and 2008. So you can see this is what the Fed does. Like, this is what happens. You have these cut cycles that bring the rates lower during these recessionary periods. You can see marked on the chart here all these different recessionary periods there. So that typically happens again well after the yield spread's inverted. You can see the drop in yields is after the inverted yield spread. Here's the inverted yield spread. The drop in yields came after the inverted yield spread. Same thing over here in the early 90s, and the same thing briefly here before the COVID drop. So here we are again with an inverted yield curve, dramatically, way more than what we had seen previously. If I were to go back a little bit further, see how far back we get data on this. Yeah, so going back to the 1980s, there's that inverted yield curve right before this drop in yields during the early 90s and that brief recession we had there. And of course, in the early 80s, there's the drop in yields. So, I mean, you can see what the drop in yields look like during all this period. And you know, again, if we're going to get 6, we're going to have a pretty significant drop in yields. And it's not just going to be the short term, you know, where the Fed is everything is going to start dropping. And that, you know, again, has not necessarily been bullish for equities during all these other periods that we've had those declines. You know, again, you can see it declines for pretty much a good chunk of time, about a year on each of these. It takes about a year for it to really get going. This one, it took a couple of years in the early 90s of declines there. So once they start, if they end up going 6 cuts, I mean, we're going to be talking about a year of cuts, which will probably won't bring us all the way down to 0, because 6 cuts would get us down to, you know, whatever that is, 4%. But to kind of give you an idea of where that is here on this chart, that would be down. That wouldn't even be that big of a drop. As you can see right now, the 3-month is at 5.45%. It's the highest out of all of these. And that would be barely coming down to where it would be barely below where a lot of these lines currently are. And you can see when you get these rate cuts, the 30-year was actually the highest at that point. But if you come over here to, let me highlight the 3-month yield here. Let's see if it will let me. Doesn't look like it will let me here, but it'll at least let me highlight the 6-month, and you can see how it's usually the top until the cuts happen, and then it ends up coming all the way down to the bottom by the time they're done. It wasn't the case in 2019, because you remember, again, we were starting to drop already before the Fed cut rates, and the Fed cut rates there in the middle of 2019. And then if you look at like some of these other periods here, here's another time frame in 2000 where the 6-month was the highest. By the time they got done cutting rates, it was the lowest. And you notice some of these other longer time frames didn't really drop that much at all, and they stayed up pretty high. Same thing happened over here, of course, in the 90s, where your 6-month was one of the higher ones. Over here was one of the higher ones, right there in the late 1989. And then by the time they got done cutting rates, it was down at the bottom. So, you know, you don't expect these will move very much, but they'll come down. But these will come down from being the highest on the yield spread, the yield curve, to being the lowest. Probably not to 0% again, because I don't think we'll get to 0. They will have 0% interest rate policy. But again, just getting to 4%, you know, again, that will barely get you below, and that's, you know, that would be 25 basis point cuts. And you can see that's generally not the type of cuts that we've seen in the past. Again, a lot of people kind of look at the 94, 95 as the soft landing scenario here. Again, we didn't have a yield. Like you can see going in at the end of 94, the 3-month and the 6-month were not the highest. So big difference now between some of these other instances where it was the highest there and highest there and highest back here in 1989. It was not the highest in 1994. So again, if we're going to use that as our analog, we are at, you know, the 3-month and the 6-month are the highest now. So it's not quite the same in terms of, you know, can we only go for a few cuts here or there without necessarily roiling the markets to get these lines to the bottom of the list from being at the top. Usually it takes a lot more cuts to do that, and ends up going a lot lower than than what was originally intended when they started the cut. What was originally expected, especially by the markets when they start the rate cuts. One other factor today is breadth. Breadth improved significantly here. If you take a look at let's take a look at the McClellan oscillator. Here we go. So we're still negative, though, at a much lower number than what we've seen for the past week. So that's a good sign. If you take a look at the breadth indicators on this chart, especially the new highs and new lows index, we jumped back above zero in a big way and jumped above the moving average in a big way. So let's see if that ends up holding. It did not correspond to a pretty, a big increase in the number of stocks above the 50-day moving average. I mean, we're back to 380, but we're still well below the moving average. So it's, again, kind of hard to really extend too far away when we are below the average, right? It's, when we go higher, you typically are above the average when you're going up, not, so far below. And the same thing with the 200-day number of stocks above the 200-day moving average are also below the average. So again, not impossible, but it's more difficult for us to continue to trend higher when we're not getting the corresponding breadth, or for that matter, the corresponding money flow associated with it. As you can see, money flow, despite the fact that we're at new all-time highs, the money flow is still not to its 52-week high, not even close to its 52-week highs, and we're still in the lower half of the chart on the money flow index down there at the bottom. Let's take a look at the sector rotation here. Let me pull up the sector moves. I'll pull up the comparison chart first. Again, you can see the last 3 months, but let's just go through the last 3 days again, starting with the 18th and going through today. And you can see XLK is really, you don't even really see XLY doing that well. It's outpacing XLP, and staples and utilities are your laggards. Healthcare and energy are also kind of laggards right now too. And you have some other cyclicals, including industrials and financials, really outpacing over the past few days. But really, it's an XLK world. If you take a look at the RRG, the relative rotation graph, this is a daily chart. You can see, again, NVIDIA is your top dog, and Microsoft's up there. In fact, when you look at the market concentration of the top 5 stocks, which now includes NVIDIA, that'd be Apple, Microsoft, Google, Amazon, and NVIDIA. Those are your top five companies now. They make up 25% of the market, which, that's kind of we didn't get above 25% in 2020 before the COVID, during the COVID response, right after the economic shutdown there, or at least the market drop there in March. The Qs got up to 25%, or just less than 25%. Well, we finally have gone past the 25% mark. I tweeted that out earlier today. So again, that's a very, very strong number for a quarter of the market to be made up of only 5 stocks, well beyond the tech bubble of 2000, of course, and like I said, beyond what we're seeing right now. Of course, that's also reflected in the CAPE ratio being as high as it is, at 32.5. Again, very stronger than what we saw in 2018 when we hit a peak there in early 2018, or in the middle of 2018 before that fourth quarter correction. We got up to 32.39, so we're beyond that. And again, not quite where we were peaking in 2021 when we were on that big inflation run, but still very high valuations. Being above 30, anytime we're above 30 is a high valuation, and we're continuing to be above 30 really since we first initially crossed above it in 2017. We've been up and down for a few corrections, but we've been spending most of our time up above 30. So very, very high levels. Again, not the start of a long-term expansionary cycle, but still towards the end of a long-term expansionary cycle. Again, that started off of that low point right there in early 2009. All right, now let's take a look at our trade idea today, and it's going to be on Disney. And you can see a nice little breakout here occurring. Dark green shading the green line, the intermediate line crossing above the chart's midpoint, getting into bullish territory. Not quite above the market sentiment line yet, but strong near-term line position suggests that there's a good chance it will. You can see from a weekly standpoint, The intermediate line has been bullish, right, in bullish territory for a while. You crossed above the 30-week moving average before a little bit of a pause and then breaking out again. You can see the near-term line and momentum line also getting the overbought zone there. So good opportunity on a really overbought or oversold stock, excuse me, on a long-term basis. This is what this chart looks like. You're getting a golden cross right now, the 10-week crossing up above the 30. You've been kind of fluctuating up and down, above and below the 10-week. Last week getting above it, so we had 3 transition candles, turning into a pretty strong bullish candle here today. Excuse me. Well, yeah, today for this week. Obviously, the week there's got a few more days left in it. Looking at the 3 green arrow chart, of course, we have 3 green arrows. The MACD is also above 0. Stochastic's getting in bullish territory. You're breaking above the point of control, looking like you're trying to break out above the value area of the chart here. Looking at the RSI and the CCI, you can see how we are now crossing above 60 for the first time and above 200 at the same time there. So very good move from that perspective. You already had crossed above 100. You made a run back down towards 0. You're running back up above 100 again, and potentially back above 60 on the weekly RSI. So that's a good trend. You had a good strong bullish trend. It faded as we tested the cloud. We're back above the blue line. The green line's crossing above the blue line. You're back to a positive rate of change, and you're that close to a new weak bullish trend developing, as you're easily above the cloud there. So a good opportunity for things to change around. The DMI also shows a bullish breakout pattern above 30, well below 10. The ADX almost crossing above 20 there. And then finally, your Bollinger Bands and your Keltner channel, you are crossing up above both the upper band and the upper Keltner channel with just the momentum that's just barely turned bullish. And you still have red dots. You don't even have the green dots here. You're probably another day or 2 away from the green dots. So it looks like you're just kind of getting started on a good bullish run here. So what I decided to do was to come out to April, buy the at-the-money call option, set my stop order at 50%, and go for a couple of these contracts. This is what it looks like here on this chart. So by the end of the expiration cycle, if it does hit, let's go. Get all of it. If it does go, if we do end up holding it all the way to expiration, which is unlikely, but if we do, then you notice we can get a pretty, for $500 of risk, if we get stopped out at our stop, getting about a $2,300 reward at a 1 standard deviation move. That's a pretty good opportunity there, again, for a very small amount of risk. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread. Let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us and follow us on Twitter and Facebook as well. Join us at marketscholars.com. Have a great rest of your Monday night, everybody, and we'll see you all next time.